What's going on, channel members? The end of the year is approaching, so I wanted to give you some knowledge about taxes. This is not advice, should not be construed as advice, and you should definitely consult a tax professional, a CPA, chief financial advisor, whatever. Through trials and tribulations and through trial and error, I learned not all accountants are the same, and I just wanted to share some of my personal knowledge with you and guide you, but not advise you. The end of the year is happening. The end of the year is considered December 31st, and you want to give yourself about a week before that. So whatever you're going to be doing, do in the next month or so. There is a term called tax loss harvesting, and tax loss harvesting is done by rich people. Now, most people don't know about things like this, so I'm going to explain it to you. You get to learn about this as you make more money because you want to keep as much money as possible. Tax loss harvesting is when you have an investment, specifically taxes in crypto. You could also do this with real estate, but it's a little different. But with crypto and stocks, you could also do precious metals. But for the most part, most people I'm talking to right now are going to be crypto and mostly equities, right? Stocks. It's when you have a paper loss and you want to actually realize those losses. What's a paper loss? You buy something in April for $1,000 worth. And right now at the end of the year, that $1,000 worth of stock is only worth $400. For example, you have a paper loss of $400. A realized loss is when you actually take that paper loss of $400 and write it off in your taxes. When you write something off in your taxes, that is pushed forward indefinitely for the rest of your life to offset any gains in the future. This is called tax loss harvesting. Also, up to $3,000 of whatever you're going to be writing off as a tax loss harvest is pushed towards your regular income in perpetuity. So every single year. So let's say, for example, you're going to write off $10,000. You bought something in April for $20,000. You bought $20,000 worth of Tesla stock. Right now, it's worth $10,000. You sell your stock, and now you have a paper loss of $10,000 to be a realized loss of $10,000. 2023, you can deduct $3,000 of the $10,000 against your personal income. In 2024, you can deduct another $3,000. 2025, another $3,000, and 2026, the last $1,000. And you deduct it from your total income. So that means you're going to be paying taxes on $3,000 less every single year, and on the final fourth year, it's $1,000. Now, the tax rule, the tax code changes all the time, so they might increase this and give you a bigger write-off, but whatever. So whatever you tax loss harvest, up to $3,000 can go against your personal income. Now, let's say you tax loss harvest, which means you take a paper loss into a realized loss, that same $10,000, and let's say you took $10,000 loss for Tesla. Next year, Palantir goes to the moon, and you made $100,000 profit in Palantir, right? You sell your Palantir, for example, and you have a $10,000 loss in your Tesla, which you offset next year against your $100,000 gain. So that you only have to pay taxes on the $100,000 minus $10,000, $90,000. You don't have to pay taxes on the full amount because you already have a realized loss because you tax loss harvested this year. If I am losing you, ask a question. If you don't ask a question, I cannot answer you. I'm assuming people are understanding what I'm saying. This is only for channel members. And if you guys want a live, I'll do a live just for you guys. If you want me to bring an accountant on, I'll ask my accountant to come on. If you guys have questions, just ask. So now you know what tax loss harvesting is, how to take a paper loss into a realized loss. Now you know how to offset that realized loss against your personal salary or against a realized gain in the future. Now, there's also going to be something called long-term capital gains and short-term capital gains. The name of the game for real estate, for equities, stocks, for crypto, and for a couple of other things is to reduce your tax bill. How do you reduce your tax bill? I'm not going to be talking about state taxes because every state has a different tax bracket. Hopefully you're a part of the 9 states that don't pay taxes. I'm part of New York, which is the second largest tax. It sucks. But let's talk about federal for 1 second. Everybody has a federal tax bracket between 10% and 37% for the most part. Some people have 0 if you make like nothing, but it's normally, for the most part, 10 to 37%. Now I'm going to be talking about a single person right now, right? If you're single, not married. If you're married, these numbers change, but you guys are going to get the gist of it in terms of your brackets, but not the long-term, short-term capital gains. So a long-term capital gain is anything that you sell after you held for 366 days or more, so more than 1 year. And a short-term capital gains is anything that you held for 1 year or less, or 365 days and less. If you sell something 1 year or less, you have to pay your regular federal tax bracket. So whatever your regular federal tax bracket is, that's what you're going to have to pay, which is normally 10 to 37%. If you hold for 1 year or more, and I'm going to give you guys the brackets in just a moment, you will be paying between $0 and 20%. If you make less than $44,625, you will pay $0 in long-term capital gains, right? That's pretty freaking good. If you make between $44,626 and $492,300, you will only be paying 15%. And if you make more than $492,301, you will be paying 20%. But again, 20% is better than 37% on your federal tax bracket. 15% is better than the 20 to 30% you would be paying on those same tax brackets. And $0 on anything under $44,625 if that's your salary. If your salary is between $125,000 and $250,000, and when I say salary, that means your salary and whatever capital gains you made. So your salary, let's say, is $80,000, and you ended up selling $100,000 worth of capital gain stock. Now it's $180,000. So anything between $125,000 and $250,000, you will have to pay an additional 3.8% Obama tax when you sell your stocks or your crypto or real estate. That $125,000 to $250,000, the reason there's a range there is if you're single, if you're married, if you have children, or if you are married and claim single taxes. Again, talk to your tax professional. I'm just giving you a detailed, broad overview, not specific to you, but enough information for you to do your own research. What people end up doing is, since it's the end of the year, they do this tax loss harvesting, where essentially you're selling your stocks or your crypto that is underwater, that have paper losses, right? A lot of people got hit in 2023. I deducted a shit ton in 2022. When everything was going down the drain, I was deducting a lot of taxes that I have to push forward. So when I'm going to make a huge hit, I'm going to be paying minimal taxes because I already wrote off a lot of losses in 2022. And again, this gets pushed forward every single year. The reason I'm telling you this is to take advantage of the tax loss harvesting. Now, there's a couple of ways to play this. Anything that you sell today, let's say Tesla, let's take it again. You bought Tesla for $10,000 in April. Right now your Tesla is worth $5,000. You want to take a deduction of the $5,000. You can sell Tesla today, which is November 10th, and then you can buy Tesla back on December 11th. If you wait 31 days, so 30 days and less, you don't get the deduction. But if you wait 31 days, you get the deduction and you can buy back in the stock. This is called a wash rule. You have to wait 31 days. If it's crypto, there is no wash rule. So if you have any losses in crypto right now, just switch to another crypto. Let's say you have Ethereum, switch to Bitcoin, then switch back to Ethereum. The loss is then calculated. Anything like that you can do. And it's very easy when you hold your crypto in an exchange like a Robinhood or Coinbase, whatever. And they keep track of it for you. So now we know exactly what a long-term capital gain is. Anything over a year, a short-term capital gain, anything less than a year. We know the tax brackets. Instead of paying 10 to 37%, you guys are going to be paying from 0% to 20%. We know what a wash rule is. If you keep something more than 31 days, if you sell something and you don't buy it back within 31 days, then you get to actually deduct the taxes, and then you get to hold the stock. If it's less than 31 days or 30 days, you don't get the deduction. And for crypto, there is no such rule. Also, if it's between 125 and 250 between your personal income and your capital gains, you're going to have to pay another 3.8% for Obama tax, right? And these are essentially the tax rules. And people that are rich use this really good. I'm going to give you a couple of examples of what you can do. Let's say you want to take a tax loss harvest for a stock. Let's say it would be, I don't know, let's say Tesla. Let's just use Tesla again. But you're scared because you don't want to risk that Tesla could go to the moon. You can buy an ETF that holds a large significant amount of Tesla, but not specifically Tesla. And this way, if Tesla takes off, you get the write-off of the actual Tesla stock, and you actually get the gains of the ETF going up. It's not exactly one-to-one to Tesla. Or, instead of buying Tesla, you could just buy an ETF that's bullish on Tesla. For example, there's ETFs that are Tesla times 1.5, Tesla times 3, right? It's bullish ETFs for Tesla. So you can buy an ETF just as long as it's not that specific stock. Also, if let's say you sell in your personal account, you can buy in your retirement account. And then after 31 days, sell in your retirement account, buy back in your personal account. This is a way to legally take advantage of the wash rule, but hold the stock at the same time so that you can do the tax loss harvesting. Do you guys understand what I'm saying? One more thing I wanted to tell you. On January 1st is when the 2023 season starts for IRAs. An IRA stands for an individual retirement account. There's essentially three main IRAs. There's a SEP IRA, which is an IRA for self-directed if you own your own business. There's a Roth IRA, which means you pay taxes pre-income, and this way when you retire you don't have to pay any taxes at all, zero taxes on the money that you have in that IRA. And then there is a traditional IRA where you get a tax deduction for that money, and then when you retire you have to pay taxes, but you don't have to pay taxes until you retire, which is going to be 59.5. By doing this you can have many gains, and by 59.5 maybe your salary is only, for example, $44,625. So if you move to Florida, for example, let's say at 59.5 you start taking out $44,625 of capital gains. You pay $0 in taxes when you retire. Why? Because the long-term capital gain says that you pay 0% on $44,625 or less. Now, by the time you retire in 59.5, for example, for me, this would be another 20 years. That number is not going to be 44,000. That number keeps going up. That number is probably going to be like 60,000. So I'm going to be able to take out $60,000 and pay $0 in taxes. It's pretty good, right? It is super beneficial to understand things like that. Also, there's a lot of other benefits when it comes to opening up an IRA. If you're opening up a traditional IRA, for example, by the time you retire, you can move to a state that has no taxes. For example, for me, I want to move to Florida. Right now I'm in New York. So I save another 9% in taxes by moving to Florida. So not only am I not going to have to pay federal tax, I'm not going to have to pay state taxes. Essentially, I'm going to be able to give myself like a $50,000, $60,000 salary and pay $0 in taxes or close to it. Again, everybody has a different use, a different case, a different scenario. But the point of this video for my channel members is for you to understand the concept and to be able to accumulate wealth, generational wealth for you and your family. 99% of people do not understand, know, or comprehend what I'm saying right now. Thank you very much for supporting my channel. Thank you very much for buying me a coffee with $3 a month. I appreciate you all. I'm trying to give you content that actually affects the way you live your life. If you have any questions, please ask me down below. Thank you, and enjoy the rest of your Saturday.